Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by Paramount Residential Mortgage Group.
In today's mortgage environment, providing our wholesale community with the best combination of product, pricing, technology, and service is paramount to their success. PRMG, built by originators for originators.
Welcome to another edition of Master of the Markets. I'm Barry Habib, and MBS Highway is created exclusively for Mortgage News Network, brought to you by our friends at PRMG. They're working for your best interest. It's going to be an interesting week this week. They've all been interesting, right? Rates are just moving all over the place. You're going to get some inflation data and housing data this week to look at. The inflation data is important because that does have an impact on rates. Now, the housing data, obviously, we have to communicate to our customers, and housing has been really strong. Now, when we take a look back at last week, what a volatile week it was in the interest rate environment, and more importantly, what are the key markers we need to look at going forward? There's probably some questions that you have. Rates have come down a lot. So first thing I want to talk to you about is make sure that you're calling your customers that you've done loans for, do their refinances. There's, according to Black Knight, 9.7 million households, 9.7 million households that can benefit from a refinance of, get this, 0.75%. Wow. So maybe let's reduce your rate 0.5% and do it with very little cost or no cost if it's possible. And this way you can't lose. Because some of you are asking the question, should I wait for rates to go down? Because listen, I've been forecasting lower rates, and even though many people thought I was crazy when I talked about the lowest rates ever, remember when the 10-year Treasury was near 2.5%, I told you this was going to happen. We're getting there. It's not going to be in a straight line. But what if for any reason we come up short? Well, here's the thing, is that you can do their loan now, save them a lot of money right now, and then do it again when you get that opportunity. But this way it's a safeguard in case things don't pan out. And I think they will. I think rates go lower. You still can protect your customers and do right by them. There's no shame in doing a ton of refinances, especially right now. 50% of the market's refinances. Why not protect those and help those customers that you promised to do so for when you did their loan originally? And also, many of you are asking, because you see what's going on with Treasury yields, and you see that there's more inversions out there, which is pretty interesting. There is going to be a recession that hits us. And you've been asking, when I see that 10-year Treasury come down, mortgage rates have not come down as much. What is going on there? And you've seen days where the 10-year Treasury's had a big day and mortgage bonds didn't have as good a day. Well, here's what's happening. First of all, they've never moved in lockstep. There's always been a mistake. If you want pricing, you look at mortgage bonds. That's what you're going to be priced off. The 10-year Treasury is totally different. However, it will move directionally the same. It'll be a good barometer. It's a good technical indicator. So it's a good one to watch for direction, but for exact pricing, they've never been in lockstep. And anybody who says that is completely wrong and just has not looked at the data. So they'll move similarly, but never in lockstep. The other thing is, remember now, the Fed has stopped quantitative tightening, which means that as they get runoff from the bonds that they're holding, mortgage bonds and treasuries, especially now a lot of them from payoffs, the change that they made is they're not reinvesting them in mortgage bonds. They're reinvesting them all in treasuries. So you'll see a more pronounced move in treasuries than you will see in mortgage bonds. And then there's this thing called convexity buying. I know it's a crazy name, but it has to do with duration. If you're a fund and you say, look, I'm going to invest in things that have a specific duration, 10 years, 7 years, 8 years, one of those things might be mortgage bonds. But now with interest rates lower and with the forecast for them to go lower still, there's a shrinking of them. We're going to be doing a lot more refinancing. So mortgages that are held by people aren't going to be there for 7 or 10 years. They'll probably be there for 2 or 3 or 4 years. So that fund can't invest in it. So they have to let go of some of those holdings and buy treasuries. Now, interestingly enough, by buying more treasuries, it spirals because then treasuries come down and eventually drags down mortgage bonds on the overall with them. The other thing you're hearing a lot is currency. And the currency issue that you see now between the US dollar and the yuan is very important. Some people say, well, if China wanted to retaliate, could they sell their $1 trillion in treasury holdings? That would not be good for them, because if they want a weaker yuan, which they do, that gives you competitive advantage for exports, your best bet is to buy treasuries, because that takes yuan out of circulation and puts more dollars into circulation on a relative basis, which means that the valuation of yuan is weaker against the dollar, and that's what they want. If the U.S. wanted to counterbalance that, believe it or not, what we would do is we would buy Chinese bonds, and that would actually help to weaken our currency. We won't do that. There's a lot of reasons for that. The one belt, one road thing in China, we don't want to be a financer for that, so that China could do trade with all of the rest of Asia and Europe without us. So it's very, very detailed. It's a complex puzzle, but the bottom line is that we're looking at lower rates ahead. It's not going to be a straight line. Key price point for you to look at on the 10-year Treasury is 1.78. So long as we stay under 1.78, I feel pretty good that we're headed continuously lower, not in a straight line. But 154 is the next benchmark to the downside. I think we will hit that. I think we'll eventually break that. And then the next stop will be challenging the lowest rates ever. We've come a long way. There's a little more to go. There may be even a lot more to go as far as lower yields. If you haven't gone MBS Highway, you're nuts, because we cover this every day. We protect you guys. People have been making mistakes. It's so funny. I hear people talk about, well, I just lock every loan that comes in. Well, how's that work for you for the past 9 months? Really? How many upset customers do you have? How many pricing exceptions have you had to ask for? How much more costly has it been to your business? And how easy did you just make it for a fintech company to replace you? Think about those things. You need to be an expert. It is no longer acceptable to just know how to qualify somebody and consider yourself a mortgage professional. You need to be a financial advisor. We help you do that every day. Get on board. This is your career. If you want to get serious, get on MBS Highway. Talk to you next week.
PRMG continues to provide our wholesale partners across the nation with better technology, better product, better pricing, and better service. Our nationally recognized brand is more than just an image. It is a symbol of integrity. PRMG, built by originators for originators. Be sure to click on the link below for your free 30-day MBS Highway trial.
This is Mortgage News Network.